The screen didn't ease into danger, it slammed into it. One moment the market looked calm, almost polite. The next bids vanished, spreads blew out, and silver reminded everyone why certainty is a liability in thin markets. What unsettled professionals wasn't the speed of the move, but the silence that followed. No cascading panic headlines, no emotional capitulation, just absence. And absence in markets like silver speaks louder than noise. Most people still haven't processed that distinction. This was not fear-driven liquidation. This was positioning. A quiet, deliberate reshuffling happening beneath the surface while attention stayed glued to price alone. Right now, we are inside a narrow decision window where the market is not debating direction, but allocation. Who ends up with metal and who settles for a promise written on paper? 36 hours sounds dramatic, I know, but timelines always sound dramatic right before they expire. Silver doesn't announce regime shifts with press releases or breaking news banners. It signals them through missing offers, thinning liquidity, and a sudden impatience from those who actually require the metal to function. Under $80 isn't compelling because it feels cheap. It's compelling because it may not exist much longer in meaningful size. That distinction matters more than price itself, yet almost nobody talks about it openly. The silver market isn't large, it's thin. That's not opinion, it's math. Compared to equities, bonds, even gold, the available float in silver is laughably small. When flows change direction, there is no shock absorber. The market doesn't glide, it snaps. What looked like chaos over the last few sessions was, in reality, something far more controlled. Inventory was being repositioned, not dumped. The clearest signal wasn't where selling appeared, but where it didn't. Futures absorbed pressure. Paper absorbed pressure. Physical premiums, however, refused to collapse the way they normally do during real liquidations. That divergence is not random. When futures weaken, but physical demand doesn't blink, it tells you price is being allowed to soften, while supply is quietly secured elsewhere. That isn't fear, that's planning. Silver has always been a market that humiliates certainty, but it also rewards those who understand structure over sentiment, and right now structure is tightening while attention remains elsewhere. This isn't the moment people will remember later as exciting. It's the moment they'll remember wishing they had taken more seriously. What makes this moment dangerous for complacency isn't volatility, it's timing. We are not in a growth cycle where excess inventory can cushion shocks. We are coming out of years of underinvestment, rising extraction costs, and tighter financing conditions. Silver isn't oil. You can't turn a valve and flood the market when sentiment shifts. Bringing new supply online takes years, not weeks, and the market understands that even when it pretends otherwise. Above-ground inventories that once acted as buffers have been steadily drawn down. This doesn't show up in headlines because inventory stress is subtle until it breaks. It appears first as small irregularities, delivery delays that get brushed off, registered stocks quietly shrinking, lease rates creeping higher in corners most people never look at. By the time commentary notices price has already moved and choices have already narrowed. At the same time, a familiar behavioral trap is forming. After sharp moves, markets often enter a hesitation phase. Everyone feels burned. Bulls hesitate to buy afraid of another drop. Bears hesitate to press afraid of a snapback. Volume dries up. Volatility compresses. To outsiders, it looks calm. It isn't. It's tension. Silver is exceptionally good at exploiting this phase. The lack of movement convinces people they still have time. They don't. When the next move comes, it won't arrive gently. It comes with gap slippage and decisions forced under pressure. That's how thin markets resolve imbalance. Yes, silver has embarrassed confident narratives for decades. Yes, it can remain irrational longer than comfort allows. But this time, the stress isn't just psychological. It's logistical. When markets break from fear, they recover. When they break from physical limits, they reset. And resets don't ask permission. They quietly reprice reality. One of the most overlooked signals in markets like silver is not who is selling, but who isn't. Right now, long-term holders with real metal are remarkably calm. You're not seeing panic unloading at local dealers. Vault exits aren't accelerating the way they typically do during a true collapse. Instead, what's happening is quieter and far more telling cautious accumulation on weakness. That gap between surface sentiment and underlying behavior matters. Markets don't move on what people say. They move on what people do when it actually costs them something. Industrial demand plays a critical role here, and it's often misunderstood. You can delay buying stocks. You can postpone reallocating bonds. You cannot pause a manufacturing line that requires silver without creating losses that dwarf the cost of the metal itself. Solar electronics, medical equipment, defense systems. These sectors don't speculate on silver. They consume it, and consumption is not flexible in the short term. Historically, industrial users are never the first to blink. They pay up quietly because the alternative is operational failure. That's why suppression phases in silver tend to end abruptly rather than gradually. The market can debate narratives for a while, but eventually it collides with reality, and reality doesn't negotiate. Another layer that deserves attention is producer behavior. At these price levels, marginal producers aren't facing extinction, but expansion becomes unattractive. Hedging loses appeal. Capital spending slows. That tightens future supply even as current demand remains sticky. It's a slow-motion squeeze that feels manageable until suddenly it isn't. Like compressing a spring you can't see, each small push feels harmless until the release. None of this implies a straight-line move higher. Silver hates fantasy. What it does imply is asymmetry. Downside pressure here is increasingly sentiment-driven, while upside pressure is rooted in necessity. Those forces are not equal. One can be delayed, the other cannot. And markets eventually stop rewarding denial, no matter how fashionable it becomes. There is a structural reason why prices holding under $80 feel unstable, and it has nothing to do with chart patterns. At these levels, the market is quietly discouraging future supply. Marginal producers aren't collapsing, but expansion becomes unattractive. Exploration budgets get trimmed. Hedging loses appeal. These decisions don't matter today. They matter later, precisely when demand shows no sign of easing. This is how tight markets stay tight longer than expected. Supply doesn't disappear suddenly. It hesitates. And hesitation on the supply side compounds over time. Demand, meanwhile, remains stubbornly inelastic. Industrial users don't wait for confirmation when production is at stake. They secure material when they can and argue about cost later. That behavior rarely makes headlines, but it reshapes the market underneath them. Liquidity also changes character before it vanishes. Offers don't disappear outright. They appear smaller. They return with conditions attached. Spreads widen for no obvious reason. Delivery windows stretch just enough to be dismissed as routine. This is how supply cliffs form, not with explosions, but with quiet withdrawals that most participants rationalize away. The danger is assuming that today's availability guarantees tomorrow's access. In silver, access often becomes the trade before price does. Once liquidity is rationed, price stops being the main variable. Confidence erodes, and when confidence cracks, repricing accelerates in ways models can't anticipate. Many fall into the same narrative trap here. They assume that if conditions were truly tight, price would already be higher. That ignores how strategic markets behave. Large buyers don't chase price. They manage it. They lean on paper markets and absorb supply quietly. That approach works until it doesn't, and when it fails fast. Another misconception that surfaces at this stage is the belief that shortages appear first as obvious absences. Empty shelves, viral photos, public panic. That's not how modern commodity stress unfolds. The first fractures appear in the plumbing. Leasing markets tighten. Forward delivery commitments become less comfortable. Counterparties start preferring cash settlement or alternative terms. Those aren't signs of flexibility. They're signs of stress management. When a market subtly encourages cash instead of delivery, it's admitting something important without saying it out loud. It would rather not part with metal right now. And that matters because financial markets are built on confidence, not inventory. Once confidence starts to erode, repricing accelerates in ways that models can't capture. Silver is particularly vulnerable here because of its paper-to-physical imbalance. Multiple claims exist for every ounce that can actually be delivered. That system works as long as most participants treat silver as exposure, not necessity. But the moment even a small percentage decide they want metal instead of contracts, the math stops working. What's notable now is that delivery interest doesn't align with speculative behavior. This isn't retail suddenly getting emotional about bullion. This is institutional and industrial demand quietly shifting preference. When that happens, markets don't adjust smoothly. They scramble. There's also a global layer most people underestimate. Silver isn't consumed evenly across regions, and pricing signals don't move in perfect sync. At times, one region is effectively signaling urgency, while another is still debating technical patterns. Those divergences get arbitraged until transportation costs rise, financing tightens, or uncertainty slows the flow. When arbitrage breaks down, regional premiums stop being curiosities and start becoming warnings. If you're only watching one price feed, you're seeing a shadow of the market, not the market itself. And shadows have a habit of disappearing abruptly when the light changes. There's a narrative trap that always appears when markets reach this stage. The idea is that if conditions were truly tight, price would already be much higher. That logic assumes markets are reactive. They aren't. They're strategic. Large participants don't chase price. They manage it. If you need silver over the next few quarters, the worst thing you can do is broadcast urgency. You lean on paper markets, allow price to soften, let weak hands exit, and absorb supply quietly. This isn't conspiracy, it's procurement logic. The irony is that these efforts to control cost often create the conditions for violent repricing later. Suppression works until it doesn't, and when it fails fast. What follows isn't a debate, it's a reset. That's why silver moves in bursts rather than trends. Another psychological layer is unfolding right now. Retail sentiment is fractured. Some believe silver is dead money, others expect an immediate explosion. Both extremes are usually wrong on timing, but useful in context. Markets tend to move when conviction is low and confusion is high. That's where we are. Bears are tired of pressing a market that won't collapse cleanly. Bulls are tired of waiting for a breakout that keeps getting delayed. That stalemate isn't neutral, it's combustible. All it needs is a catalyst that forces action rather than opinion. Silver, for what it's worth, has no interest in your thesis. It doesn't care about macro frameworks, watch lists, or perfectly annotated charts. It cares about flow. And flows are beginning to lean quietly and persistently in one direction. When flows dominate, narratives scramble to catch up. That's when tone shifts appear suddenly. Analysts who dismissed supply stress days earlier will call it new information. It isn't. It's old information becoming undeniable. The market doesn't change its mind, it reveals it. And when it does, the window for comfortable positioning tends to close first. One of the subtler shifts happening right now is in time preference. In stressed markets, immediate delivery begins to matter more than future promises. That's when spot prices start behaving differently from longer-dated contracts, sometimes in ways that look technical or harmless at first. But when the market starts paying a premium for present metal over future metal, it's urgency expressing itself in structure. That whisper usually comes before the shout. Most people ignore these signals because they're quiet and inconvenient. Professionals don't. They understand that pricing structure often tells the truth before headlines do. This is where backwardation doesn't need to be obvious to matter. Even small distortions in delivery timing can signal a deeper imbalance between confidence and availability. Another overlooked adjustment happens in adjacent markets. When silver tightens, you often see subtle changes in behavior elsewhere. Alloy formulations get reconsidered, procurement contracts are rewritten, recycling programs receive renewed attention. These aren't bullish talking points, they're coping mechanisms. Industries don't invest in alternatives unless their primary input is becoming unreliable or expensive. These decisions happen behind closed doors long before they appear in reports. By the time they're visible to the public, the supply issue is already well advanced. That's why waiting for confirmation often means paying for it. There's also a global dimension that adds friction. Rising transportation costs, tighter financing, and geopolitical uncertainty slow arbitrage. When that happens, regional premiums stop normalizing. They persist. That persistence is a warning, not a curiosity. None of this guarantees a clean move higher, and anyone promising that is selling entertainment, not analysis. What it does suggest is that the cost of being wrong on the upside is rising faster than the cost of being wrong on the downside. That asymmetry is what serious capital pays attention to. Markets don't remove options loudly. They narrow them quietly, and right now silver is doing exactly that. This is the phase where fatigue quietly takes control. Analysts are tired of being early. Traders are tired of being chopped up. Long-term holders are tired of explaining why fundamentals haven't mattered yet. That collective exhaustion creates a false calm, a sense that nothing decisive will happen because nothing decisive has happened so far. Historically, that calm isn't stability. It's the market inhaling. Silver has a habit of repricing when attention is lowest and conviction is thinnest. The most important moments rarely feel dramatic in real time. They feel dull. Price drifts. Commentary repeats itself. Participants convince themselves that waiting carries no cost. That's usually when the cost begins to rise quietly. Skepticism deserves respect. Silver has a long history of false starts and has punished impatience more than most assets. Every cycle brings reasons why this time should disappoint. But there's a difference between repeating a slogan and understanding context. This moment isn't defined by optimism, it's defined by constraints. Constraints don't negotiate, they assert themselves when ignored long enough. Another reality worth understanding is how quickly narratives reverse once price moves. The same voices dismissing supply stress today will pivot effortlessly. They won't say they were wrong, they'll say conditions changed. That's how financial storytelling works. Incentives reward reaction, not anticipation. Waiting for consensus means volunteering to pay the premium that consensus creates. This window is unforgiving because it offers no clear signal. There's no single data point that announces the shift. Instead, pressure builds through many small stresses that align at the same time. When they do, the move from hesitation to urgency happens faster than comfort allows. There's a moment in markets like silver when the conversation itself becomes outdated. Most discussion right now is still anchored to price levels debating whether under 80 feels cheap or risky. But that framing is already behind the curve. The real shift begins when participants stop asking how low it can go and start quietly asking whether they'll be able to get it when they need it. That shift doesn't require headlines or confirmation. It starts with a few failed assumptions in the right places. Delivery timelines slip. Terms adjust. Quantities get revised. The word temporary appears more often, and temporary is a dangerous word in commodities. Temporary shortages have a habit of turning into permanent repricing events once behavior changes. When procurement managers receive calls about delays or altered terms, decision-making accelerates. Production doesn't wait for consensus. Material gets secured where possible, even at prices that would have been debated months earlier. By the time these changes appear in reports, the supply issue is already well advanced. Silver's role has evolved quietly. It's no longer just a hedge or an industrial input. It sits at the intersection of energy transition technology scaling and defense readiness. That gives it a strategic dimension. Strategic demand behaves differently. It doesn't chase dips. It builds buffers. And buffers remove material from circulation longer than most expect. Markets also tend to reprice when participants are most fatigued, not most alert. The first reaction to early movement is disbelief. People assume another false start and wait for a familiar pullback. That hesitation allows repricing to happen with little resistance. By the time confidence returns, the range has already shifted. Silver never announces these moments, it only reveals them after they pass. This is where perspective matters more than prediction. Silver has never rewarded precision. It rewards preparedness. The investors and operators who tend to navigate this market best aren't the loudest bulls or the loudest bears. They're the ones who understand structure, respect constraints, and accept uncertainty without freezing. They don't need to be right on timing. They just need to avoid being wrong on fundamentals. Right now, under 80 still offers something rare in markets under stress optionality. It offers choice. You can think. You can size appropriately. You can act without urgency forcing your hand. Above that, especially after a sharp move, optionality shrinks. Decisions become reactive. Costs rise, not just financially, but Emotionally, emotional decisions are expensive. They lead to poor timing, poor sizing, and regret later disguised as strategy. Silver has always been the market that humbles ego. It doesn't reward bravado or certainty. It rewards those who prepare quietly while others debate loudly. Structurally, this market is far tighter than surface-level price action suggests. Supply responds slowly. Demand, particularly strategic demand, does not wait for comfort. That imbalance doesn't resolve politely. When people hear phrases like last chance, they often assume hype. That's not what this is. Think of it as a narrowing corridor. Markets don't close doors with alarms. They close them softly, then act surprised when people knock later and no one answers. If you're paying attention, you can see the hinge moving now. Slowly, quietly. What happens next may be gradual or it may be sudden. Silver enjoys keeping that detail to itself. But